Welcome to Talk Tickers. So, POSCO stock has been a huge laggard in a red-hot sector. The big question is a turnaround finally in the cards? We're going to break down their Q3 2025 earnings call to figure that out.
All right, let's get into it. First, we'll hit the Q3 earnings snapshot. Then we'll unpack the real story behind those numbers. After that, we'll dig into the company's guidance and what analysts were grilling them on. And finally, we'll put it all into context and give you our take on what's next for the stock.
So, the top-line results for the third quarter. Well, they were a mixed bag. And to be honest, it was a pretty noisy quarter. Let's try and separate the signal from that noise.
Okay, so you can see revenue dipped both from last quarter and last year, coming in at about 17.26 trillion won. But that's not the interesting part. Look at the operating profit. Yet, it's down year over year, but it actually jumped almost 5% from the last quarter. And get this, that's the third straight quarter it's gone up. That's the real story here.
So, how did the market react? Pretty much with a collective shrug. POSCO's US-listed shares, that's ticker PKX, they've barely moved, closing up less than 0.5%. And what that tells you is that investors were pretty much expecting all this headline noise and are already looking deeper.
Right, so to really understand what's going on, you have to pop the hood. Because when you do, you see there are really three completely different stories unfolding inside this one company, all at the same time.
First up, you've got the core steel business, and it is absolutely steadying the ship. I mean, even with the slow market at home, management was able to get that operating profit margin back up to 6.6%. How? Just good old-fashioned discipline, higher sales volumes, and some really proactive cost-cutting. This is the engine room, just grinding out better results.
Next, you've got what's supposed to be the future growth engine, the battery materials business, and it is showing major signs of life. Losses got a lot smaller, really fast. That was driven by a jump in cathode sales and a nice rebound in lithium prices, which even let them reverse a 37 billion won inventory loss. Management was crystal clear here. The priority is just execution, execution, execution.
But here's the problem. All that great progress was basically hidden by the infrastructure division, which is just a major drag right now. The POSCO E&C unit had to book over 288 billion won in one-time costs from a safety incident, and they're expecting another 230 billion in Q4. You know, it seems like management just wants to rip the Band-Aid off and get all this bad news out of the way by the end of the year.
So that brings us to their guidance. Let's look at the forward-looking statements and see how they plan to juggle these competing forces, especially based on what the analysts were focused on. No surprise here. Analysts really wanted to know about the EU's new Carbon Border Adjustment Mechanism, or CBAM. I mean, for any steelmaker, this is a huge potential cost looming on the horizon. And management's answer was basically a three-pronged attack. 1, double down on their own carbon reduction efforts. 2, keep talking, keep negotiating directly with the EU. And 3, if they have to, they'll strategically shift lower-profit steel that would get hit hardest by these tariffs to other parts of the world. The other big question was about capital allocation. You've got a cyclical steel business on one hand and a super capital-intensive battery business on the other. So where exactly are they going to put their money to work for future growth? And the focus is pretty clear. Expand steel capacity in high-growth markets overseas. They're specifically named India, Indonesia, and Australia, in that exact order. But they also said they're committed to stabilizing their battery investments. And, interestingly, they're keeping their eyes peeled for any good M&A deals that might pop up.
Okay, so to really get the investor mindset here, we need to zoom out. We need to see how this stock has actually been performing compared to its peers.
And wow, the difference here is just stark. I mean, look at this. Over the past year, the broader metals and mining ETF, that's a whole basket of similar companies, it soared over 55%. And POSCO? It's actually down more than 6%. It has been a massive, massive laggard.
So this underperformance really sets up the central debate for investors, right? The stock has rallied over 15% in just the last month. So the key question everyone is asking is this the beginning of a real catch-up trade as the company finally cleans house and lets those improving fundamentals shine through?
All right, so after putting together this noisy quarter, the forward guidance, and the market context, here's our call on the stock. We are assigning a market perform rating, and here's why. It's a balanced view. We see the clear operational wins in both steel and batteries, for sure. But we think the short-term drag from that E&C division, plus the stock's recent little run-up, warrants a neutral stance, for now.
So the trade idea here is to watch for three specific catalysts. First, we need to see that Q4 report and get confirmation that all those E&C charges are officially in the rearview mirror. Second, we need to see hard data. We're talking proof that those lithium plants are ramping up and getting qualified by customers. And third, the big one, we need a clear, confident outlook for 2026. If management can deliver on those 3 points, that could be the trigger for the big, multiple catch-up that investors have been waiting for.
So, will POSCO finally close that huge performance gap with its peers? That's the billion-dollar question we'll be watching. As always, this is not financial advice.